conference is now being recorded. We have connected the line to the main conference.
So we should start now.
Ladies and gentlemen, thank you for your patience. We have the line for Dr. Raghuram Rajan connected. You may go ahead.
Yeah, thanks, Simba.
Okay. Good morning, everyone. You all have seen the statement, I presume. So I'm not going to read out anything. I'd be happy to take questions, and my colleagues here will also help me answer. Alpana, would you like to choose?
Good afternoon, Anirudh here from ET now. So just want to firstly understand the SLR cut fully, and given the fact that the last time you came up with an SLR cut, a number of bankers did not pass that on. The general understanding is that the SLR cut would infuse some money into the system and therefore bring down the cost of credit. That doesn't seem to have happened in the last couple of months. So if you could explain to us how this would.
See, the idea behind the SLR cut is if the government finances are improving and the government is on a fiscal consolidation path, we can afford to liberate more sort of access to government financing and make it possible for the private sector, for the public sector firms to get access to that financing. Now, they may not need it right now, but we're hopeful that as the economy picks up and credit growth gets stronger, the banks will be able to use that space to lend to the productive sectors of the economy. What the cuts do is they create that room for the banks to plan, for the sort of borrowers to anticipate that money will be available as needed, and also for the government over time to take that into account as it manages its financing. I think the best time to do these cuts is when credit is not, credit demand is not so strong that the cut suddenly converts into a substantial increase in credit demand and a substantial shift away from government bonds. In fact, as many have said, the banks today have surplus SLR. So we think this is more about planning rather than about immediate effects, and therefore I would not anticipate large effects in the market today, but I think it would help the market going forward.
Governor Subhash from Reuters. I wanted to understand the liquidity management that framework that you're trying to kind of accommodate in the policy. What exactly is the RBI's thinking on liquidity? When you're saying that you will review the liquidity management framework, what does it exactly mean? Because apparently the recall rate has been oscillating between 9 to 7% in a wide band for quite some time now.
Yes, we have looked at those oscillations, and as we have said in the past, we are trying to keep the rate closer to the 8%. Now, some of those oscillations are because of substantial and unanticipated variations in government balances, and we try to work with that, but that does create a certain amount of volatility. As you know, there are increases in balances before tax dates and so on, and some of that you can anticipate, but the size sometimes is not fully is not easy to anticipate. Even spending is sometimes hard to anticipate. What we're looking at is the possibility of doing more frequent term repos, of shortening the maturity of term repos, and perhaps also thinking about the timing of the auctions during the day so as to minimize volatility. Now, to do this in a reasonable fashion, we are doing the analysis that is necessary, and hopefully within a very short period we will come out with any changes. I'm not saying that will necessarily be changes, but these are the things we're looking at, and we will come out with those changes so as to see whether we can smoothen the process. Now, Any change, I mean, we did move away from keeping these windows open. Of course, if you keep windows open to an unlimited extent, you remove all volatility. The whole idea was to move away from that regime to go to a regime where liquidity was auctioned for the most part. We have made that transition. Now we have to work on fixing some of the issues that arise, and we will do that.
Could I just add something to
Yes.
that? Just a couple of points. One thing to notice is that in July, the average call volume has come down by 40%. So it is a thin market, and therefore, as you know, in a thinner market, volatility is amplified. The average daily call volume has fallen from 16,000 crores to about 10,000 crores. Secondly, even by the standards in the past of fluctuations in government balances with the RBI, given the late budget and the fiscal deficit target that the government has laid out, in July, the turnaround in these balances were of the order of 90,000 crores. So these were special circumstances, both from the viewpoint of the volume and the government balances. The third factor is that we find that the call money market is highly skewed. There are about 4 or 5 banks who are perpetual users of this, with a slight odd variation in that. And therefore, looking at these microstructure and the overarching environment provided by the government change in cash balances, July was a particularly peculiar month. Thank you. No, just the change in government balances, yeah.
Good morning, Governor. Saloni from Bloomberg TV. So 2 questions. First, on the fiscal deficit front. 2 months down, we've already exhausted 56%. Are there any worries on fiscal slippage? Do you think there will be a fiscal slippage? Is the 4.1 number feasible? Second question on the inflation and rate trajectory. In June, you mentioned that if the economy stays on this course, further policy tightening will not be warranted. This time, you're saying that we are keeping a watchful eye on inflation. Given the fact that 2009 we saw the worst drought in almost 37 years, we are way off the 2000 mark as well.
First drop in?
On the drought front, sir.
Drought.
If we don't see astronomical rains in August, we're going to end up on deficit monsoon. How do you see the rate trajectory panning out?
Okay. First, the market seems to have read our previous statement and tried to put an emphasis on certain words and de-emphasize certain words. As I read it, it was if the economy stays on this course, further policy tightening will not be warranted. In other words, if it does move away from this course, tightening will be warranted. And on the other hand, if disinflation adjusting for base effects is faster than currently anticipated, it will provide headroom for an easing of the policy stance. So I think it was two-sided. If it moves off in the upside, we will tighten. If it moves on the downside, we will be able to loosen. If it stays in the path, we will stay with where we are and adjust appropriately. I don't think our stance has moved from where we were last time. I think we see the short-term risks as being more balanced than they were last time. There is the issue of the monsoon, which you talk about, and we have to wait and see. We're not weather forecasters. We have to wait and see how it plays out. Let me emphasize that a below par monsoon doesn't necessarily mean significantly below par production. It depends on where the monsoon is below par. And second, significantly below par production doesn't necessarily mean higher food prices. It depends on food management, how much we allow in terms of imports and so on. So there is no one-to-one correspondence between all these things. The government has stated quite frequently that it is keeping its eye on food production and taking steps, and we have to wait and see how that plays out. I think what we are saying is that if disinflation proceeds as warranted, we will eventually have room to cut rates. Now, I want to emphasize that the RBI in no way will hold rates high any longer than necessary. There is a path we are trying to achieve, and we want to achieve that path. We're not against growth. but we do think that growth will be most benefited if we disinflate the economy and we don't have to fight this fight again. Let's fight the anti-inflation fight once, and let's win, and that will create the best conditions for sustainable growth. And I think the government, which has a long term a long horizon in mind, given that we just had elections, is on the same page, that let us bring inflation down. Of course, government has its role cut out. We have our role cut out. On the fiscal deficit, I think the government, the past government and the current government have stated again and again they are on the fiscal consolidation path. I don't think there's any reason to doubt it.
Morning, Governor. A definite addition in this time statement is para 9, perhaps, where you are reminding us of the next target of the Reserve Bank, the balance of risk around the medium-term inflation path, and especially the target of 6% by Jan 2016 are still to the upside. You didn't remind us of this in the June policy. So are we to understand that, therefore, one shouldn't be looking at this fiscal year for rate changes because the ultimate goal is 6%? What was the purpose for putting that statement there? And also to add to what Subhashri asked you, are you contemplating any change to that 0.25% money that is being available in the fixed rate one-day repo? Because the market's reading appears to be that because that is too limited and most of the money is available in the variable rate, 7-day and 14-day window, the call rates are volatile. So will there be any rethink on that distribution of money in the repo windows?
Okay, let me start with your second question first. At present, we are not focusing on that 0.25% availability. I think what we need to do is make sure all the other instruments that we're using to manage liquidity work well. That is not to say that we will not focus on that in the future, but at present that is not our focus. On the issue of have we brought in new information, yes, we're 2 months down the line. And we're getting close to the end of the year when our first target has to be met. So then the question you're going to ask is, what about the second target? And so what we have to do is remind people there's a second target also, that it's a path. And we've kept saying 8% and 6%. We need to also be confident of reaching the 6%. So let us see how things go. I don't think we know how the disinflationary process will pan out. As I said, we have an anticipation of how it will pan out. We think the 8% goal is well within reach, modulo a reasonable monsoon and modulo reasonable oil prices. Of course, those things can be volatile. I think as far as the 6% goal goes, we have said the bands of risks are still on the upside on that one. So we have to see how it plays out.
Just to supplement that, you said that the risks to the 8% inflation are now balanced, and whereas you saw them to the upside earlier. Don't the rise in vegetable prices over the past 50 days worry you? Do you see them, flowing over into the non-food, non-fuel inflation which has been coming down?
There is a seasonality in vegetable prices, and yes, some vegetables have picked up, and there's also a saliency in vegetable prices. People see the vegetable price and think, oh my God, inflation is up so much because tomato prices are up 80%. So we have to be careful. I'm not saying we can be complacent about vegetable prices, and but there has been a seasonality every year around this time they pick up. So let us see. July vegetable prices look a little steeper. But let's see, as we go into August, September, and the monsoon news also comes out, I suspect some element of the vegetable price increase is tied also to the monsoon. Let us see how these play out. We're not overly worried, but we're not complacent about them either. We are watching them very closely.
Bijoy?
Bijoy from Cogensis here. A couple of questions, but first of all, a clarification. In January, when I had referred to the macro report as country cousin, you had defended it as being part of the family. Is it now a prodigal son? It's not part of the family anymore. Moving on to my question, are you treating are you treating SLR also in keeping LCR in mind? Because is it being treated as much as an LCR enabler as a liquidity tool? And just to supplement Lata ma'am's question, on 6%, your work actually starts at 6%. It's just a glide path. So would you want to think about 6% when you make your rate moves in the future?
Okay, I have to decode that a little bit. I'm not quite sure. So let me answer the second question, and then maybe Urjit or Deepak can answer the first part. On the second question, yes, as we move to liquidity coverage ratios, and those become issues for the banks, we want to give banks flexibility. And also, I mean, to some extent, we have to, reduce the kinds of obligations that are put on the banks because they are entering a more competitive environment. So, given that, steadily we want to reduce those, consistent with the space that the government provides by rectifying its finances. So, it's part of both the attempt to meet international norms on liquidity, but also removing some domestic constraints on the banks, given that they have to compete with other financial institutions in this market. First question.
We have moved regarding our publications and the supporting documents for the monetary policy according to what was in our committee report. And there we had said that we would have the equivalent of the inflation report or the MMDR twice a year. So that was accepted in April when we made the policy.
Supplement that. There are two things which used to be there, the MMDR. One is the projections, that anyway that we have brought it into the policy. The other component was the lot of, the surveys that we had. And we have conducted those surveys like inflation expectation survey, industrial outlook survey and all that. So that soon after we also, in a day or two, will be putting in public domain. So there is no loss of information that gets into the policy making here. Yes, those surveys will come out.
Will part of the SLR be brought down because anyway the liquidity coverage ratio has to be maintained for Bijoy's question?
I thought I answered it, that we have in mind that we want to give banks more flexibility in meeting the liquidity coverage ratio. And so as we bring down SLR, over time, they'll be able to make an independent decision on what they hold to meet the liquidity coverage ratio.
But is there some number in mind as to what will be
It's
the
early
LCR
days.
LCR requirement for the system?
I think we are in the process of putting those out. Anisa?
Yeah, LCR we have given. There also we have given the glide path type in the sense when it has to be reached. And by the time they are required to reach the LCR, SLR adjustments will also be there. That's what is Governor is mentioning. It should be consistent with the overall approach towards the fiscal consultation.
Now, let me emphasize, the prime factor driving our ability to reduce SLR is government fiscal balances. So we keep that in mind. The secondary factor is to give banks more flexibility from a competitive perspective, as well as from meeting some of these stability ratios.
The question on 6%. How important is 6% in your?
6% is our ultimate goal for the foreseeable future, what we call the medium term. Long term is too long to think about right now. So let's think about 6%.
Pradeep?
So what is the kind of policy transmission that you are looking for? Because as a result of your cut in SLR, bond prices might actually fall. And the net impact on interest rate, where do you see it? Do you really see funds moving to the productive sector as you've promised?
See, we're trying to sort of do management in a very difficult environment. Difficult in the sense that growth is lower than one would like it to be in the best of all worlds, while inflation is higher than one would like it to be, again, in the best of all worlds, right? So, do we push growth even lower, or do we try and enhance the aspects of growth that can also help inflation? So one way of thinking about what we're trying to do is we're creating an environment where perhaps we can enhance the supply side without at the same time giving too much, let me emphasize the too much, encouragement to the demand side. So we need projects to be completed. We need infrastructure to pick up because they are holding back the supply side of the economy. So we need to create the environment for that to be possible, even recognizing that while you buy more coal or you put in more concrete into the ground, that will enhance demand. So these things can't be completely separated. But we are trying to ensure that the supply side is encouraged without providing too much of a fillip, given the growing demand, to demand once again and then creating more inflationary pressures. So it's a fine balance that we're trying to draw. And as often stated, we don't have too many tools. The interest rate tool is a very blunt tool. We're trying to use some of the other tools. Now, all this is being done at the same time as we have to recognize that the economy itself is changing. And we have to give space to our financial institutions to adjust to the new economy. And so when you think about an SLR cut, we could stay with SLR where it is forever. But that is an old obligation which puts constraints on the balance sheet of the banks. And so to give them the space to deal with the new economy, we have to steadily think about bringing it down once the government gives us the fiscal space. And that's what we're trying to do. So there are lots of moving parts here. And to see this only in terms of A or B is, I think, a little unwarranted.
So you don't really expect the loans to be cheaper for anybody because of the policy action you have taken, right?
No, the intent wasn't the SLR cut was not intended to make loans cheaper today. It was to give banks more flexibility on their balance sheet going forward as some of the demands on the banks pick up, as credit growth picks up.
So one more question, if you allow me. We are getting information that CBI has started collecting data on NPA and CDRs from various banks. Would you confirm that?
Do we have any information on that?
No, we know as much as we read in media. We don't have any specific information on it.
So no information has been sought from RBI as such?
As you mentioned, the information when it is being collected from the individual banks, and I think they will have more granular information. So that must be the issue.
Post syndicate, are you asking for any further information from the banks? I mean, is RBI seeking info?
Look, there is a inspection underway of Syndicate Bank, but I think one has to be very careful about extrapolating this issue to the entire banking system without thinking further through it. It does raise troubling issues, this particular situation, and it is important for the law and enforcement agencies to ensure that full investigation is done, and I think they're doing that. I would emphasize that one shouldn't extrapolate from this to the entire public sector banking system and assume that all the problems in the public sector banking system are because of criminality rather than because of other factors. I think the balance has to be maintained. And we have to be also careful that while we do a thorough investigation and culprits are brought to book, it doesn't become a witch hunt, which then stalls the entire credit process. So we have to be careful, and I think the investigative agencies will do their job appropriately.
Governor, if I can just add to it, Gopika from CNBC. Bankers tell there is a larger question of pricing of loans. We remember RBI had come out or had set up a working committee to look into this pricing of loans. There was no consensus that emerged after that. In sense, RBI had not come out with final guidelines. Bankers say that probably that's something which could solve this issue, and so is that something that we could expect, that probably the transparency in pricing of loans and that could solve these kind of anomalies from happening?
See, it's impossible to be. The whole point about banking is about taking risks and using your discretion in taking those risks, right? You have to know how somebody you may trust a little more because they have, there's some chemistry that works. That's relationship banking. So for the outside to dictate this is the price that you're going to have to charge in this case takes the banker out of the equation. In that case, we might as well put a machine there and give loans based on the machines. And some machines do that, but it's basically for small loans. This is what's called credit scoring. But I think for some of these large loans, it's impossible to take out banker judgment. So when there is banker judgment, you have to be careful about what is genuine banker judgment and what is not genuine banker judgment. And that's, to some extent, a very, very hard thing to do. So I don't think the answer is to make all loans uniform based on some observable characteristics, because then you might make some very, very bad decisions because you're not using your feel, your intuition for the character of the borrower. Character loans are a big part of lending. So we have to live with this. I think this episodes of the kind that is alleged to have happened suggest that we need to look again at the governance of public sector banks and understand the deficiencies there and try and improve it. There are lots of highly qualified, highly reputable people working in the public sector banks. They shouldn't all be tarred with the same feather. We were, I think, lucky enough to welcome Mr. Mundra onto the RBI just a few days ago. And there are many people of high caliber there. And what we have to see is how to encourage them, how to give them the space to work because they're working in the nation's interest.
Lata, can we bring back the attention back to the policy? Gabriel had a question.
Hi, good morning, Governor. Gabriel Senior from the Wall Street Journal. You're saying in your statement that you know that investor risk appetite has buoyed financial markets, and that has generated portfolio flows to emerging market economies, and that could always revert. Now, I would like to ask you, what is the RBI doing to ensure that there is no capital flight or leading to any slide in the value of the rupee ahead, and what you think are the main risks in international finance scenario and the geopolitical risks that you mentioned in your statement? Thank you.
Right. First, in terms of what we have done, I think it's been a joint effort by the government and the Reserve Bank to try and improve the macro fundamentals of the economy. Amongst other things, the fiscal deficit has been kept on a glide path that has been suggested by the government. Second, the current account deficit has come down significantly since there were concerns last May. From about 4.5% of GDP on an annual basis to something closer to 1.5% to 2% today. Third, our reserves have increased substantially since then. We are in a much healthier reserve position. And fourth, and this I don't want to diminish, I think the expectation that we will confront and deal with inflation is much stronger now than it was earlier. And one of the big concerns investors have coming in, and I hear this frequently, is are you going to take away the benefits from Indian growth from us by inflating and thereby depreciating the rupee? And the answer is no, we have no intent of doing that. We want to bring inflation under control and more like the inflation in other countries so that the rupee is not seen on a continuously weakening path. So all these things are, I think, big differences from where we were in May. I keep saying in international fora, India is not a problem anymore. I think there's a perception of a problem. I don't think there was a real problem last year. But I think today